Hi folks, welcome to this recording on an equity in method investment. We have a significant influence investment by the acquirer Blake, and the company that they have acquired a significant ownership interest in is called Sturgis. In this example, you're going to be doing two key things. You're going to be comparing the equity method, where significant influence exists, to the cost method, and we're going to be seeing the differences in the statements, particularly the income statement and statement of comprehensive income. And we're also going to look at the changes and how the investment account or the investment in the company that you significantly influence on your balance sheet, how it changes, whereas under the cost method it doesn't. So we're going to look at those two concepts again with our particular question. So you can see here, just to quickly go through the question, we have a company, Blake, and on January 1st, year 5, they purchased 25% of the outstanding common shares of Sturgis for $1.85 million. Sturgis's income statement related information gives you profit before discontinued operations here in the first column. We give you some OCI, net of tax, discontinued operation gain only in year 5, but there's nothing in year 6. So even though this title here says profit before discontinued operations, I put that DO reference in because there is DO here, but nothing here. But that doesn't matter. Just that here the 148 doesn't include any discontinued operation stuff, right? And then we've got some dividends declared and paid. And as you may recall, that is going to be a little bit different under the equity method as opposed to the cost method and how we handle it. All right, so in the first part of the question, we're going to assume that Blake significantly influences its associated company, Sturgis. And I'm going to ask you to calculate comprehensive income, make some journal entries, given that it's a significant influence investment for Blake over Sturgis, and look at any of the disclosure requirements that are required for these significant influence investments on Blake's financial statements. Then I'm going to give you some information from Blake's statement of comprehensive income for both years 5 and 6, and you're going to do a statement of comprehensive income for me, given again that Blake still has significant influence. And then we're going to calculate the ending balance in the investment in Sturgis, which is going to be the account on the balance sheet and Blake's balance sheet. All right. And then in part B, we're going to assume that Blake is not a publicly traded company, but it is a private company and follows ASPE. Don't forget, when they follow ASPE, they can choose to use the cost method or the equity method to record the investment. We're going to assume they use the cost method. So what we want you to do now is to prepare all the journal entries in years 5 and 6, assuming ASPE, using the cost method. That's what Blake would be using. And do a statement of income for Blake. And then in part C, we're going to compare the cost method to the equity method. And we're going to say if Blake wants to show the lowest debt to equity ratio, would they prefer to use the cost or equity method? This is going to be particularly meaningful if you are an ASPE company, right? Because in ASPE, they have a choice. So with that data in mind, let's have a look at the solution. So here I asked you to calculate comprehensive income. So what I did for year 5, if you look at Sturgis's information, we've got income of $51,800. That is the profit before discontinued operation. We did have a discontinued operation in year 5. We had a discontinued operations gain net of tax of $2,400 plus the OCI. Don't forget, when you're calculating comprehensive income, underneath net income you have the OCI you have to pick up. And because it's an unrealized gain, we're going to pick it up as an increase. So we've got $65,500 now in year 6. Don't forget, in year 6 you didn't have any discontinued operations. So whatever the profit is you have here before discontinued operations, the DO here was 0. All right, so we don't have any of that to worry about. So we're going to start with our 148 and add our unrealized gain, which is your OCI piece, 29,600. And because we have no DO, we're not going to include that. So we have comprehensive income of 177.6. So again, remember, comprehensive income has to include any OCI if it exists. All right. So now we've got that. And now we're going to look at the journal entries. The journal entry at the date that Blake bought its 25% ownership interest in Sturgis is going to debit the investment and credit cash for the amount that they paid for that investment, which is $1,850,000. Now at the end of year 5, December 31st, we're going to look back at the end of the year and we're going to say, okay, now how much income did Sturgis earn? Because we, as Blake, because it's a significant influence investment, we have to pick up our pro rata share of that. Because we only own 25%, which gives us a significant influence, we have to pick up in year 5 our 25% interest or income from Sturgis. That includes our profit before the discontinued operation. We have to include our share of Sturgis's OCI that they booked. And we also have to include our share of the discontinued operations gain that Sturgis booked. That's going to affect our equity method income. So after we make our original investment entry on January 1st, we're going to debit the investment in Sturgis and credit our equity method income for any income that Sturgis earned before the DO. And we know that was 51.8 from our question. You'll remember if we go back, we had that right in the question, 51.8. We're picking up our share of that guy. All right, and that's 25%. So we debit the investment and we credit equity method income. That's an account that Blake has, and it's going to show up on its statement of comprehensive income. Now we're also going to pick up our share. Blake will pick up its share of the OCI that Sturgis booked. So again, we said it's part of the equity method income because we're picking up that piece that the associate earned as unrealized gain. So we debit our investment, increase our investment in Sturgis. Don't forget, these are Blake's entries, right? And we're going to credit the OCI based on our relationship with the associate for $2,850. How do we get that? Well, again, if you go back to the question, you can see the OCI in year 5 that Sturgis booked was $11,400. So 25% of that is $2,850. Now we also have to pick up our share of the discontinued operations gain on an after-tax basis that Sturgis had, and that was $2,400. So 25% of that, that's our pro rata share, debits the investment and credits the discontinued operation equity method income for $600. Now, before we go on to show you a compound journal entry and how you can, instead of making 3 entries if you want to make 1, I think it's important that we repeat an item that we've probably talked about before in class, and that's this. Even if Blake doesn't have any OCI on its own, even if Blake doesn't have any discontinued operations, if its associated companies do, we have to pick up our pro rata share. So you don't have to have Blake have a discontinued operation or any OCI in your own separate entity statements. The fact that a company you significantly influence does, you got to pick up your share of that whether you got some or not. All right? Now, moving on from that concept, if you chose not to make these 3 entries, you might want to make what I've got down here in the purple ink, a compound journal entry which brings all 3 of these together. The reason why, and that's the reason why I made you calculate the comprehensive income, because some students might prefer to do these 3 entries as one. So I'm going to use my comprehensive income calculation that I made up here for year 5 and make my journal entry. What would I do? I would debit the investment in Sturgis for my pro rata share of that comprehensive income, which would give me $16,400. Now, how does that my share of that pro rata, or my pro rata share of that comprehensive income breakdown on the credit side? Well, that investment in Sturgis, which is based on that comprehensive income, has 3 pieces to it. It has the $51,800, which is, as part of that 65.6, you have the $51,800 that you took your share of, the $2,400 of the DO that you took your share of, and you took your share of the $11,400, which was the OCI your share of the OCI that Sturgis booked, right? So that's how it broke down. You took your share of the OCI, right? You took your share of the DO, and you took your share of the profit before tax. These are all equity method income amounts that have to show up on the income statement. All right. The last entry I made here is to record the dividend that Blake received from Sturgis. Now, don't forget, because we're using the equity method under a significant influence investment, what we need to do is we need to debit the cash we received by $18,500, which is our 25% share of the dividend that got paid out to us, and we're going to credit the investment in Sturgis. Why? Because don't forget, any dividend that's declared and paid out to us is really our return on the investment, so that's reducing the investment, right, by $18,500. So it's like they earned this and they're giving it back to you as Blake. So Blake credits its investment in Sturgis, okay, by $18,500. This is a hallmark or key feature of the equity method. We would credit the investment in Sturgis, which is a balance sheet account, to record any dividend declared and or received by us, okay, from an associated company. We would have to reduce our balance sheet balance for that investment account, or that investment in Sturgis account, because we're getting back that return. So it's considered a return on the investment. Okay, so now, next part. Let's have a look at year 6. So again, if we had to make the entries, don't forget I'm not making an entry to make an entry to take any pro rata share of a discontinued operation, because you remember in the question we didn't have a DO in year 6. Right, there was no discontinued operation, so I'm not making that entry. So I'm really only going to make 2 entries now as Blake. I'm going to debit the investment in Sturgis, which is my balance sheet account, to find Blake for $37,000 and credit my equity method income. Don't forget, this $148,000 is your income before discontinued operations, or in this case your net income, right? So that's $37,000, but I also have to take my 25% share of any OCI that Sturgis booked. In this case, the OCI is a credit or a gain, right? So I'm going to book my share of it. So I'm going to debit the investment and I'm going to credit the OCI because it's a gain, right? My OCI went up, and OCI is a credit when it goes up. So I'm going to credit it for my pro rata share, which is $7,400. Now again, you could use your comprehensive income amount here if you so chose, and said, well, I'm going to increase my investment in Sturgis by $44,400, which is my pro rata share of the entire comprehensive income. And how does that comprehensive income of $177,600 break down? Well, it breaks down into a couple of different pieces. Your pro rata share of the $148,000, which was your net income, or your profit, your income before the discontinued operation, which again is this piece here, your $37,000, and your OCI that you took in because of your pro rata share of the OCI that Sturgis booked. Sturgis booked $29,600, so $29,600 plus the $148,000 is going to give you $177,600. So you would break down the equity method income into its 2 pieces. Your income that you took of the associate before any DO, of which in this case there was none, before any OCI, and then you take your share of the OCI. Again, there's no DO, so we didn't need to make an entry for that or include that. So you can do it again, just like we did in year 5. You can do it this way, do 2 entries, or if you wanted to do a compound entry, no big deal. Do that too, it's good, but always show your calculation, eh? And then again, because the dividend was $74,000, again, we take our pro rata share and we debit cash and credit the investment in Sturgis for our share of that dividend. Now, I just thought of something I wanted to add to you in this particular case. If it was the case that Sturgis declared the dividend but didn't yet pay it out to any of its shareholders, including Blake, because don't forget, Blake has a 25% ownership interest in it, right? Instead of debiting cash, we would debit dividend receivable on Blake's books, right? because they're waiting to receive it, but we would still credit on Blake's books the investment in the sub or in the associated company, Sturgis. Why? Because Sturgis is the company that you significantly influence. So you know you're going to get that dividend. So it's going to be paid at some point in time in the very near future. So, because that dividend receivable is a current asset, right? So if it was the case that it was declared and wasn't yet paid, you would still credit the investment in Sturgis. But if it was only declared and not paid, you'd be debiting a dividend receivable, right? If you're Blake. Okay. So now, the next thing I ask you to do is to disclose talk to you a little bit about what Blake should disclose regarding its equity investment in Sturgis, given that it has significant influence. I just highlighted some of the key things. The name and the place of the associate is important, but the method used to report the investment in associate, again, if you're an ASPE company, you have to say whether you're using the cost or the equity method. If you're a publicly traded company, you still have to say you're using the equity method. Now, you have to report any equity method income from Blake's investment in Sturgis. It should be reported separately on the income statement, which when we do the income statement in the next part, we're going to show you where that goes. So we would show that. And we also have to show the carrying amount of the investment on Blake's separate entity balance sheet. So we would have to show that there too. We have to disclose it all right on the balance sheet. We'd also have to state, I mean, again, that's why I asked you to calculate it, so that I know if you can calculate it, then we'll get to where we place it on the balance sheet. The percentage ownership. So Blake would have to say it has a 25% ownership share in Sturgis. And we'd also want to prepare, we wouldn't do full statements for Sturgis, the company we significantly influence, but we might want to give some summarized financial data. You may find sometimes that companies do it in the management discussion and analysis section. They might also do it as part of the notes to the financial statements. But it needs to be somewhere in that big, massive financial report. And these last two items are very, very important. The nature and extent of any significant restrictions on Sturgis's, that's your associated company, to transfer any funds to Blake in the form of a cash dividend or repay any loans that it made to Blake or advances, right? So the idea here is that if we think Sturgis is in big trouble, and we've loaned money to this associate because we're kind of their cousin, we're trying to help our sister or brother, we're trying to help them out, right? We're associated. If we think, we might not get it back, or any dividend that we're expecting to receive, we know, hey, listen, maybe Sturgis can't pay it, maybe something bad has happened, we need to report that in there too. And any contingent liability related to your interest in the associate, meaning, let's say that Sturgis made a loan and you approved it, because don't forget, you had something to do with this loan that maybe Sturgis made because you significantly influenced. They might have needed your signature to go out and get the loan, but you said it was okay. Now, if they're not able to pay back that loan to an external third party, maybe a bank or another creditor or something like that, then guess what? That could be a contingent liability to you as well as other creditors for your share. In fact, if you remember in one of your prerequisite courses, we talked about that concept. So when we looked at contingencies and liabilities, we talked about that and estimating liabilities and stuff. So that was kind of in there, we talked about that. So again, this one is really relating to any significant restrictions when Sturgis can't pay you back. But this contingent liability thing is relating to any amounts that Sturgis may not be able to pay back to external shareholders over and above you. Okay, so these would be important disclosures. So now I'm going to cut this video off here, and then I'm going to work on a second video, and we'll go through the statements and the calculation of the investment in Sturgis account in a little more detail.